And so now it's my great pleasure to introduce our outstanding interns, who are extraordinarily capable individuals who are going to each be providing some brief insight before we move to the Q&A of the meeting. Andrew has been with us off and on for several years. Sounak joined us this summer, and among other responsibilities, he was responsible for coding our automated structure dividend capture solution in Python. So Danielle, I'll turn it back over to you for proper introductions for these outstanding gentlemen.
Wonderful. Thank you so much. So I'm just going to quickly introduce our first speaker, who is Andrew Park. Andrew Park is an upcoming senior at UCLA, and he studies business economics and is a member of the Benjamin Graham Value Investing Concentration, which I just have to say is really cool that UCLA has that. So Andrew, please go ahead.
Okay, great. Thank you. Hello, my name is Andrew Park, and today I will be presenting the importance of considering growth in addition to valuation in your investments. Now, one public misconception surrounding value investors, which is quite common today, is an emphasis on a laser focus on valuation to achieve outsized returns. As the popular expression goes, paying 50 cents for a dollar, with the idea of relying on advanced screens to dig up these cheap discounted companies. But as time has shown, using this approach and analyzing businesses solely with cookie cutter ratios and formulas which tell you what's cheap relative to current value, it can be really an inefficient way to find success in the markets, as it fails to place emphasis on understanding the future trajectory of businesses. This is a classic case of the Ben Graham style of investing versus the Phil Fisher approach. The Fisher approach placing much more emphasis on forward-looking growth, whereas the Graham style of investing, one tends to become so focused on paying the absolute cheapest price that you might end up stuck with businesses that are either in decline or a stagnant state with no real catalyst in the future for price appreciation. Now, what we are looking for are quality companies which will continue to face higher demand in the future, have healthy and expanding margins, and an exceptional return on capital. And when investing over the long term, what you really want to own are a few high quality assets which will continue to compound your capital. This stresses the importance of quality, deep, bottom-up fundamental analysis. Yet, when dealing with these high quality compounders, proponents of the old school approach to value investing often place an overemphasis on current valuation, which causes them to overlook some of the most exceptional companies in the world that you see today. However, an aversion to paying an expensive multiple within reason may not be nearly as consequential as many people might assume in the face of terrific company fundamentals. While any company may seem expensive at the current moment, it's crucial to consider their underlying economics and what the company could potentially become within, let's say, 5 to 10 years or so, and not solely where they're at in this current moment. As an example, Apple has traded at an average PE ratio of 20x over the past 5 years, which is still arguably high multiple. Yet, even paying what would be considered an absurdly high multiple of 55 times earnings for Apple in 2011, something no traditional value investor would ever consider, you would have still earned a 10% annualized return over the next 10 years. Now, as a disclaimer, this is not to say that valuation does not matter, or that one should consider investing unconditionally in Apple or similar tech stocks at 55x multiples. Valuation is extremely significant, and it is the mindset of every value investor to find the greatest deal possible. In fact, when you combine extraordinary compounding power with the major discount to fair value, taking Berkshire as an example, you have the potential for outsized returns from both a valuation and a compounder lens, the best of both worlds, achieving a strong level of downside protection with a much higher asymmetric level of upside potential. And this principle teaches us not to compromise quality for valuation, and that paying a high multiple of earnings may not necessarily make a bad value investment. It is much more a focus of understanding the business which determines investment quality. And in the end, all intelligent investing should be considered value investing. And it is simply a matter of determining where you will grow your capital the most in the future. And that concludes my presentation. Thank you. And with this, I will pass it on to Sounak for his presentation on philosophy applied to investing.
Wonderful. Thank you, Andrew. So quickly, just to introduce Sounak. Sounak Mitra has a bachelor's in economics from UCLA and a master's from NYU as well, where he studied philosophy and bioethics. He also has a strong computer science background, and among many things, as Matthew already mentioned, Sounak wrote the Python code this summer that automated the structured dividend capture strategy. Sounak, over to you.
Thank you, Danielle, for the introduction. Hello, everyone. My name is Sounak Mitra. Now, I would like to talk a bit about philosophy's value to value investing. In my opinion, philosophy is actually quite misunderstood in popular culture. If you ask a random person what he understands by philosophy, they'll probably say that it concerns with the deeper questions about life. What is the meaning of life? Why are we here? What is the meaning of meaning? What is the right thing to do? Now, don't get me wrong. While such questions are very important and core to philosophy since ancient times, I believe it paints a very narrow picture of the discipline. Not to forget, it makes most people regard philosophy as an armchair discipline, since because it does not add any value or growth to society, especially since no concrete answers are to be found for such questions. However, philosophy's true value to society, and especially as investors, lies in the manner of critical, logical, and procedural thinking that it promotes. It is in bringing such analytical thinking to the investigation of investment opportunities that the true value of philosophy lies for the modern value investor. Philosophy is the mother subject. All sciences and humanities emerge from it. However, science and its established techniques can only go so far at any certain point in time, especially as it approaches its limit in gathering further evidence. After a certain point, newer questions become unanswerable, and we are back to philosophy once again. The value of philosophy as an analytical approach lies in this realm. It is to ask critical questions that have not been asked before and to not simply rely on already established methods to analyze situations. Our investigation of the Daily Journal Corporation actually exemplifies this approach very well. Daily Journal SAS division was all but unknown until a few years ago when Charlie Munger made an often comment about the division. Marked by our curiosity to understand this venture and Munger's association with it, we asked further questions about it. Unfortunately, annual reports hardly talked about it. We later found out that Daily Journal has been secretly trying to establish a case management system to improve efficiency throughout the courts and district offices of North America and Australia. We even scoured the internet for contracts and even analyzed hundreds of county meeting minutes to gauge its potential. We questioned its business model and we realized how resilient it's going to be once it is fully established. We even attended employee training sessions for the system undercover and asked employees questions to gauge their satisfaction with the system. Had we merely relied upon annual reports and financial statements, we would have never discovered the golden goose that Daily Journal is poised to become. It is because we were curious and asked questions no one else did that we were able to develop confidence in Daily Journal. And now everybody's talking about it. Furthermore, we value investors also have to deal with a lot of indeterminacy surrounding our investment prospects. This reminds me a little bit about the Sorites paradox, a paradox arising from weight predicates. Consider a heap of sand from which we remove grains of sand one by one. At what point in time does this heap of sand stop becoming a heap? Or consider a man losing hair. At what point in time and at what number of hair strands on his head does he finally change from a man with some hair on his head to a bald man? Similar question actually surrounds analysis of past data in the investment world as well. For example, we may ask at what time can an overpriced stock potentially turn into a value stock? Or after how many years does a great track record become credible? 4 years, 7 years, even 10 years? When thought about deeply, the above class of questions is actually a difficult one. Philosophers have been debating about resolving this problem for ages. Solutions and arguments have been proposed to adopt certain approaches. However, counter arguments to such solutions have also been presented. The situation remains completely unsolved, and that is why it is still a paradox. However, being aware of such philosophical problems at least makes us realize that many of the demarcations that we resort to in daily life are quite honestly arbitrary. Boundaries are actually quite fuzzy. We still have to make concrete decisions though, like when to proceed with an investment prospect to make any progress. However, being aware of such philosophical concepts can make us make better informed decisions. It develops wisdom in our analysis of the world. The development and acquirement of such wisdom is another value that philosophy provides us. Finally, I would like to talk a bit about the philosophy of values upheld by the firm. This is important to delve into because without understanding one's guiding principles, it is difficult for anyone to extend one's trust to somebody else. In short, what our firm stands for is what finance veteran and famed author of The Black Swan, Nassim Taleb, calls having skin in the game. Now, what does having skin in the game mean? To have skin in the game is to follow the principle whereby one is unable to put others at risk without being exposed to harm himself. It is to be exposed to the same risks when making major decisions for somebody else. This is best understood by a short story. According to Hammurabi's code, an ancient Babylonian legal text, if an architect built a house and the house collapsed and the homeowner died, the architect was actually put to death. Now, an architect building houses arguably knows more about the craft of building than any inspector who inspects such buildings. Therefore, in general, it is possible for an architect to cut enough corners for personal profit such that an inspector might declare the house stable and suitable for residence, when in fact it is actually unstable and exposed to future collapse. However, Hammurabi's code even prevented this possibility because if something were to happen to the homeowner and he was harmed, the same harm would be levied upon the architect. As a result, architects always made sure to make the most stable of houses. This is called having skin in the game. So why am I talking about the arguably grim topic of having skin in the game? Because it is the only moral and especially efficient mechanism of risk management that ensures the best outcomes for all those involved. It eliminates any unsuitable asymmetries among various stakeholders. Furthermore, having skin in the game is necessary to truly have a deep understanding of the world. When it comes to investing, no stone may be left unturned in our research since we are exposed to the same risks as everybody else. We simply cannot afford to be complacent. Now, we have skin in the game at Peterson Capital Management. As you might know, Mr. Peterson's family is among the largest partners in the firm, with the vast majority of his entire net worth invested in the fund alongside yours. Along with value investing, our firm's core investment philosophy is also capital preservation and limitation of downside risk. Our portfolio is concentrated on our best ideas, as you saw. We keep our portfolio turnover low, holding most of our positions for many years, and we focus on minimizing taxes and expenses. We also avoid excessive leverage. What affects you affects us as well. Therefore, to come full circle, our risks are the same as yours. Our growth is aligned with your growth, and hence our incentives are aligned with yours. We have skin in the game. We aim to add deep value to your lives. We are here with you for the long run to ensure that your wealth grows for generations to come. Thank you. And with that, we'll get back to Danielle for the Q&A session.
Thank you. How fun to have different perspectives coming into the annual meeting, and I really appreciate that both of you gave those presentations.